Okay, folks, this is a review of the problem which you submitted for Chapter 3. And at any rate, you have to turn to the appropriate page in the textbook. I just had it, but anyway, Bobby Riley here is the owner and invests in her art studio business, and the transaction calls for to record an investment in the business. So we would have to analyze and ask ourselves what accounts are affected. There must be two. They are cash and capital. They both go up. Cash is an asset. We have to debit an asset in order to increase it, and we have to credit Bobby Riley to increase her account. That's the first transaction. The second transaction is to record a prepayment of rent. Now, in this case, we're making a rather long prepayment so that instead of debiting rent expense, which is very common on a month-to-month payment basis, but if we're paying in advance, we create an asset called prepaid rent, which goes to the balance sheet. Next chapter, you'll see that as each month passes, we have to knock off or expense off a portion of that prepayment. So we're adding to one asset and we're subtracting from cash. So to add, you debit. To subtract, you credit. And a brief explanation, proper format, skip a line so that each kind of stands out on its own. The transaction will read in the textbook to purchase a piece of office equipment on account. Again, you're buying an asset. The accounts affected are the equipment account and the accounts payable account. You have to ask yourself the direction, up or down. Equipment is going up. Asset, debit to increase. Accounts payable is going up. Credit to increase. And a brief explanation. We earn money and receive the cash immediately for the performance of our service. Add to cash, add to art fees earned. These must be exactly as the chart of accounts indicates. So that we add to cash with a debit, we add to art fees earned with a credit. Brief explanation. We purchased art supplies, which is an asset. Assets are increased with debits. Debit art supplies. We're paying, so we're using cash. Cash goes down. How do you reduce any asset with a credit, as you can see here? This is what we call a sale on credit or a sale on account. So that what we need to do is establish this receivable, which is an asset, which would go to the balance sheet. So being an asset, we would debit it and credit art fees earned. You want to be careful that when you collect that account, you debit cash and credit accounts receivable. I've seen people in the past want to add, when they collect that account receivable, I've seen people in the past wanting to credit revenue again. The maximum revenue you're going to get is $4,000, so that when you receive that money from the person that owes it to you, you're going to debit cash and credit accounts receivable to reduce the amount owed to you. You've used the services of your employee, and that is using cash, so that is an expense. Expense is defined as the using up of our resources in order to help get revenue. So we debit to add to the salary expense account, $500, and we credit cash to reduce the cash account. So we've got an expense going up and an asset going down. Debit the expense, credit the asset. Bobby here withdrew for personal use. It's not an expense. It does not go to the income statement, but you know the withdrawals is an offset to capital. It's a negative owner's equity account, so that you would debit any negative owner's equity account, just like salaries expense. But that's an income statement account. But nevertheless, it takes a debit as we also debit a negative capital account here in the withdrawals. The electrical expense, again, a temporary debit. Instead of debiting capital, you debit the expense. You're adding to the expense. And then the $130 is the payment of the cash required to satisfy that bill. Again, you've used the electricity, and the theory behind that is if you've used the service and pay for it, you have to expense the amount paid in order to record the cost as an expense. A brief explanation. Same thing with the telephone bill. You use the telephone to a certain amount of activity, and accordingly you add to the expense and reduce cash. These account numbers that you see here are the accounts to which the amounts, debits, and credits have been posted. In a computerized system, sometimes all we need to do is type in the account numbers and enter the debits and the credits, and all the posting is done automatically with the click of a mouse. Now, typically when you hand keep an accounting system such as this, you have to post to the ledger as step number 2 in the cycle, and we calculate a new balance after each entry. I'm not going to go back and forth from the journal to the ledger, but that's what you would be doing. Okay, you take each line of that journal and post according to what the journal is dictating to you. So there is, in fact, if you look at your journal on November 1st, from General Journal, page 1, there's a $6,000 debit to cash that establishes a $6,000 debit balance. And then again on the 1st, there was a $3,600 payment, so that when you credit cash, you reduce. So you subtract the 6,000 from the 6,000, you subtract 36 to give you 24. There was a cash receipt of 8,000 on the 5th, which adds to the amount of cash, so that you've got a debit balance of 2,400. Adding 8,000 brings it up to 10,400. A payment, a payment, a payment, a payment, a payment, and each payment keeps reducing that balance. So starting with the 10,400, down by 350 equals 10,050, down by 500 equals 9,550, down by 300 equals 9,250, down by 130 equals 9,120, and the final reduction of 210. And that's the balance of the cash account at the end of the month. As you're going to see, that's the balance that will be carried over to the trial balance. And if we were to prepare financial statements from that trial balance, that's the amount of cash that would get reported on the balance sheet. The accounts receivable took a $4,000 debit. Being an asset, it now increases. We establish a $4,000 balance, and that would go to the trial balance and also the balance sheet because it's an asset. We still have the whole $3,600 in the prepaid rent account, but as you're going to see in the next chapter, we have to adjust that for the amount that gets expired from that 36. So you'll see in the next chapter a reduction to that prepaid rent account, leaving you with a balance less than 3,600. Art supplies, an asset, again, from the journal to the ledger. Everything is transcribed. As you can see, the transaction occurred on the 8th from General Journal, page 1. Add to the asset, establishes a balance. Equipment is purchased for $1,800, establishes a balance. That's an asset. You add, of course, with debits. Now we're swinging to the other side of the equation. The credit balance of accounts payable was established by the entry from November 3rd when we purchased something on account, so that we had to add whatever we debited. The credit was to accounts payable to show that we owe that $1,800. that carries a balance to the account of 1,800, and that would obviously go to the liability section of the balance sheet from the trial balance to which it is transferred. And here's Bobby Riley, her initial investment added to her account with a credit. So she now has a balance of 6,000. Note of information, a point of information, that is not really her true equity in the business at this time, because we know that she took out 300 for personal withdrawals. When we do our closing entries, we're going to debit Barbara Riley capital in order to decrease by that $300, and the closing process would require to close that account out would require a credit, and you'd have a zero balance over here, because like expenses and revenues, the Bobby Riley withdrawals account is a temporary account. There are the art fees earned. Again, you got a combination of two credits in a revenue account, so you're adding the 4,000 to the increase that you created when you credited the account in the first place. So you took your first balance of 8 and added the $4,000 to art fees earned, and we keep scrolling down here. You would transfer from the journal to the ledger in the posting process here, the debit and the balance. Okay, so the debit adds the 130 to the electrical expense account, and 130 is the account balance at that point. Same thing with salaries. We transferred from the journal to the ledger a debit to add to the salaries account, and the balance of $5,000 is extended. As you can see right there, telephone expense, same deal. Recorded on November 29th from the journal to the ledger, a debit of $210 and a balance of $210. Now, all of these accounts have balances then at the end of the month, and they will look familiar to you: 8910 and 4000 and 36 and 350. Notice where my cursor is. It's in the balance column of the accounts, the credit of accounts payable, the credit in the capital account, the debit in the withdrawals account, the credit in the art fees account, and we come down to the debit in the electric account. These, again, we're in the balance columns of all these accounts, okay? So that you see those account balances as debits or credits, whatever the case is, and then you carry them to the trial balance, which is nothing more than the proof that we have recorded equal amounts of debits and credits. So the trial balance is all set up in your template from the work papers, and you simply list, these are not journal entries, it's simply the list to prove debit and credit equality that was recorded in the accounts. And there you can see, and your recollection or your reference back to the ledger will show 8910, 4000, 36, 350, all as debits. Then we came into the accounts payable, where the account balance is 18 and 6, the withdrawals account 3, the fees, the revenue account 12,000, the electrical, the salaries and telephone expenses to get your final trial balance of 19.8. Now, as the accounting cycle continues, in the next chapter, you're going to see that we have to make certain adjustments to these accounts in the adjusting process, and then we would go ahead and prepare the financial statements after we prepare another trial balance called the adjusted trial balance. But if we were to do no adjustments, which I think we did back in problem 2A5, I believe it was, 2A5, we took the account balances and transferred them to the financial statements where they belong. Remember, if you needed to prepare an income statement, you take your revenues and subtract your expenses. and the difference would be the amount of net income or net loss. And then you'd go to an owner's equity statement where you would take the beginning balance of the owner's account and you'd take the revenues minus the expenses to get the net income and add the net income to the beginning balance. If it was a loss, you'd subtract the loss from the beginning balance, and you always subtract the amount of withdrawals on your owner's equity statement. And then you'd show your balance sheet finally, which would contain all of the assets on the left side, and then all of the liabilities on the right side, and the owner's equity that would be derived from the owner's equity statement. You'd never put the 6,000 there because, again, the 6,000 does not reflect the revenues, expenses, and withdrawals that have yet to be closed to show their impact on capital. I hope this helps. It should be good reinforcement for those having difficulty. I do hope it helps. Okay, so we're going to stop this, and we'll be in touch, all right?